Welcome back, everybody, to Fresh Outlook. Stocks ended mixed this week as Wall Street closed out one of its most turbulent weeks in years. It's a week that saw the major indexes swing dramatically and fall into official correction territory for the first time since 2011. Volatility continues to rule, however, on Wall Street as stocks react to comments from the Fed that an interest rate hike next month is still on the table. Let's say hello to the Fresh Outlook think tank. I'm joined by Jim McCarthy, certified financial planner and founder of Directional Wealth Management. Stephen Kalayjian, co-founder of Novara and Ronin Game Studios. Dr. Bart Rossi, a political psychologist, and joining us live via Skype is Andrew Carrillo, certified financial planner, and he manages portfolios as well. Stephen, you're up in the monitor. I'm going to start with you. I always heard when the market goes down, that's the time to buy. So are bargains to be had right now? Andrew, I'm sorry.
Oh, no. Are you talking? Oh, Andrew.
Yeah.
Not right now. I wouldn't buy this dip. I think there's a lot further for this market to fall. This is the beginning. The U.S. economy is entering a recession right now. The Fed is doing a lot of talk, but they have not healed the economy. All they've done is lower interest rates. That does create a boom, but it's not the type of boom that is durable. If they raise interest rates, that'll take away 100% of the boom they created. And that's the reason why they've delayed raising rates up till this point. They're very, very nervous about the U.S. economy. When you look at the fundamentals, they're not good. Stocks are in some of their top 5% of most overvalued markets in the last 100 years. I think there's a lot more downside than upside at the current price.
Okay, let's turn to Jim McCarthy. Jim, what is your take on what's happening in the market? Have we created a bubble by having the interest rate so low?
I would actually have to disagree with Andrew. The second quarter GDP was revised, the second revision this week, and it came out better than expected at 3.7%. Consumer spending, which is 70% of the U.S. economy, was up 3%. Inflation was still pretty tame. Year over year, PCE, which is personal consumption expenditure indicator, which is what the Fed uses, was only 1.8%. So I do agree with Andrew that the market got a little overvalued, and I also agree with him that I think, not that there's more downside necessarily, but I would like to see us retest the lows of earlier this week. A bottoming process in stocks tends to be a function of price and time. So if you picture a W, we had the decline, then we had a little rebound for a couple of days this week. I'd like to see another decline, see if you can get a bottom at the bottom of the W there, and then you might see some more sustained movement forward. But I agree with Andrew that I wouldn't necessarily be committing a lot of investment dollars at this point. I'd give it another few days.
Stephen, what are your thoughts?
My thoughts are this, basically that we had this dramatic move down, and we were kind of complacent up in the 18,001, 18,003 area. My technical work told me sometime in the third, early part of the fourth quarter to look for a move down to 16,100. It was funny, I was at school with my kids. I open my iPhone, I see down 1,000 points. I tried to buy certain things, but to answer the question, I don't think we're gonna have a retest. I'm probably 80% certain that the lows are in for the year. I do think in the next month, 3 to 4 weeks, we'll have some volatility, maybe testing somewhere in the mid 15,000, 15.8. I do think it's a buying opportunity at that point. Overall, long term, I'm very bearish. However, for this year, I believe that we should come to some type of a short-term bottom in September, get some type of seasonality boost in the equity markets between now and the end of the year, erasing a lot of the losses and maybe even pulling out a single-digit gain for the year.
Doc, what are the psychological aspects of this? And I'll ask you because we all have skin in the game nowadays.
Right.
One, we all have 401ks or IRAs, other investment packages. Teachers have this stuff nowadays. It's not just Wall Street tycoon. So when the market goes down, it hurts everybody.
It does. And if you look at any of these financial shows, you notice that they all talk about the psychology of the market. So I think it is pretty fascinating. I think the psychology really is that people go in such weird swings, extreme swings. Like we're worried about China, and then we start thinking about it, and they're having a multitude of problems. So the thinking then gets generated in such a way that we overreact and the panic sets in, and we have selling that is really beyond what it should be, and we have these lows. And then, of course, people start thinking differently. Well, you know, we only have about 6% of our exports to China. Maybe it's really not that bad. And of course, we start thinking the other way, and we get a rebound. But it's the psychology of extremes when it comes to the market. People start to think too fearfully or too aggressively.
Well, I'm sorry, I was going to say, it's been said that the stock market really is nothing more than fear and greed, only loosely tied to the economic cycle.
Greed works, my friend. Fear works, my friend. I think I'm quoting Gordon Gekko. Let's turn to Andrew for just a second. Andrew, talking about what the doctor was talking about this gut reaction that people have to the market movements, I guess this is a time when your basics should kick in and people should look to investment strategies like dollar cost averaging.
Yes, I think dollar cost averaging could be definitely a good strategy over time. I also think right now it's good to take some gains, take some money off the table. If you run this bull market up, remember it's not a gain until you sell. People thought they had profits in 2006 and 2007. Those vanished, so it can make sense to rebalance your portfolio at this point.
Okay, Stephen, has what the Fed has done to the American consumer been unfair? By keeping interest rates so low, grandma, grandpa are getting nothing on their savings. I mean, I don't even understand why people would have a normal passbook savings account anymore. You might as well just keep it in your checking account. You're not getting any interest, right? Well, CDs, if you tie it up for a year or two, you might get 1%.
Yeah,
right?
some CDs go out 5 years, you get 2%.
Right.
You know, well, basically, the Federal Reserve's mentality is try to keep interest rates low, get people excited, put their money in the stock market, and try to get bigger returns. And basically, to try to keep interest rates low to stimulate the economy. Has it worked? It's a topic for another show. Basically, they did 3 quantitative easing cycles. Feds had a balance sheet back in 2008 of $930 billion. As of, I think, last month, it was reported to have $4.5 trillion on that balance sheet. So they're buying mortgage-backed securities. We're buying back our own treasury bills. So basically, is it working? It is in the sense that they're trying to keep rates low, we're trying to stimulate the economy, and it's boosting the stock market because of Fed intervention.
So certainly also boosted the housing market, which is a big part of the economy. I mean, because when you think about housing, it's not just the buying of a home, it's all of the related industries that go with it, construction, materials, the labor that's all related to that. So the housing market has come back a long, long way. And so not only are people feeling the wealth effect in their own personal lives, but their home values are up, their 401ks are gained in value. So,
and for the small investor, basically their biggest investment is their home. So if they have a low interest rate, they can afford more of a home.
Sure.
And like you said, that home works as an economic engine for the country.
Exactly.
Yeah. Right. Let's talk to Andrew for just a second. Andrew, looking at a middle-aged person's portfolio, should it be about half in stocks, how much in cash? What is your mix right now? Because I would feel a lot of people are very uncertain right now. You've got, quantitative easing taking place, which is basically printing money. You have a stock market that I think is being inflated by unnaturally low interest rates. What should the average person do if they want to secure retirement, and let's say they're 45 years right now and mortality and retirement is nipping at their heels?
Okay, yeah, and just to talk on that point, it's good when real estate goes up for natural causes, but for a lot of people who rent, it's an increase in their shelter costs. So we've had an increase in rents of over 40% over the last few years, and for many people, that's not a good thing. And so it's only a gain, right now it's very similar. All they've done is blow up another real estate bubble. What everyone just said, it just sounds like a real estate bubble 2.0, and it's unsustainable. But going back to what you're saying regarding people's portfolio, that can depend a lot on their risk tolerance, their time frame. But I do think people are potentially overexposed to stocks right now. They've seen the market go up substantially, and they think that's going to continue to infinity. But currently, we expect the S&P to be much, much lower over the next 3 to 5 years. Based on historical valuations, we see a mean reversion coming in profit margins, and we think it's good to take some money off the table. Now, when it comes to retirees, which is mainly who I deal with, I see a lot of retirees that are maybe not that much in the stock market, but their largest risk is the bond market, is the Fed. What is the Fed going to do? How much money are they going to print? And when does it end? If 4 trillion was good, maybe 10 trillion is even better. So that's what concerns me, is inflation down the road for retirees. And I think an undervalued asset is something that people should consider when rebalancing their portfolio, such as gold.
Okay, I'm going to give you the final word, Stephen. What's your bit of advice to investors other than call you for a personal portfolio analysis?
Well, I think basically, again, staying the long-term course is not something I believe in. I believe that people should know when to take money off the table. If they see gains in the stock market, I think, again, like I stated a few months ago, I saw a significant amount of complacency amongst long-term investors. And I think people have to know when to take money off, keep some money on the sidelines for a dip like this, an opportunity, and continue to look at the economy as a whole, and then basically move money in and out when they see some good gains, and on aberrations like we saw on Monday, to get back into the market and then more or less move the money around.
So you got to know when to hold them, know when to fold them, know when to walk away, know when to run.
Bingo.
Okay. To quote a famous country singer. Jim McCarthy, thank you for your time. Stephen Kalayjian, Dr. Bart Rossi, and Andrew Carrillo, thank you for joining us. We're coming back. We're going to talk about a whole lot more in our lightning round when we look at the week's interesting stories in lightning fast fashion, or so we hope. More on that after this.